Hey, what is going on, everyone? It's Tom Bickey with Andy Mac Home Mortgage. It is Thursday, September 18th, and it's the morning after. The morning after the Fed did their rate announcement, and I get a lot of phone calls every time the Fed does something. Now, this is the first time they've cut rates since December, and everybody out there has been anticipating that this cut was coming. And they thought, a lot of people, right, in the real estate community, consumers, based on headline news and things that they see online, was that was immediately going to make mortgage rates improve. And guess what? It actually had the opposite effect. And it doesn't always happen that way, but I wanted to get in here and spend a little bit of time talking about why the mortgage market is a little bit different than the federal market. And what does that mean for you as a consumer? What does that mean for you in real estate? And how's that going to impact affordability? So the first thing I want to do is just kind of go to the charts. I'm going to pull that up here. So what you're looking at here, this graph over here, that's gray, is the mortgage-backed security price. Now, this is an inverse relationship. So what that means is when that line is going up, mortgage-backed prices are going higher. That means mortgage interest rates are going lower. So if you look here, we saw back about a month ago, all the way through yesterday, we saw some pretty nice gains in the mortgage market with interest rates improving to some of the lowest levels we've seen in nearly a year. Okay, and why is that? Right, a couple things. Right, the labor market is one of the two major data points that the Federal Reserve is looking at. They keep saying, Jerome Powell's like, we have two mandates: 2% inflation, so price stability, and a healthy labor market. So we saw some jobs numbers at the beginning of August that indicated that the labor market was weaker than expected. Big revision downward, big miss on the jobs number, like 250,000. And then the job number at the beginning of September was also weak. They forecasted 75,000 jobs, and only 22,000 jobs were created on non-farm payrolls. Both of those indicators is like leading the market to believe, like, wow, right, one of the two mandates is coming to fruition. The Fed has to lower interest rates. Now, Jerome Powell did come out after their Jackson Hole meeting and suggested that we would expect some rate cuts coming up this month. Okay, but right after the announcement during the Fed press conference, you can see that the line for mortgage-backed pricing was going down. That means rates were actually going up for mortgages, right? And why is that? It's because of what Jerome Powell said. You know, there's two key takeaways. Number one is, like, individual forecasts are not a plan. So while individual Fed members have their own ideology on what future rate cuts should happen and when and how, that is not a plan. And policy is not a preset course. So they're not saying, hey, we're on autopilot. You know, you can expect all these rate cuts by the end of the year. You had people as aggressive saying we should get 5 more rate cuts by the end of the year. That was one outlier. And you had several members saying we shouldn't have any more rate cuts this year. The median suggests that we should probably see anywhere, around 2. 2 is what you would forecast based on the prediction. But again, it's data dependent, right? Data dependency has been the main thing that we're looking at. This chart over here with the green and red, it's not Christmas time. This is the 10-year Treasury. So the 10-year Treasury rate has been coming down, got to some of the lowest levels. In fact, we touched down well under 4% yesterday, right before the Fed announcement. And then shortly thereafter, it bounced up to, some of the higher levels that we've seen, right? So we're at 411.9 on the 10-year Treasury right now, right? Ultimately, what does that mean? It means that the Fed is data dependent. And while there are weaknesses in the labor market, the overall unemployment rate is still relatively low. It's sitting at 4.3%, right? We're at near full employment. What they're seeing is that the number of people available to work jobs is fewer. Job participation is a little bit lower. Wage growth is a little bit lower. So again, signs that the economy is cooling. However, until we start seeing unemployment rates grow, that will really sound the alarm for the Fed to say, wait a minute, maybe we got something going on here that we need to be more concerned about. Again, easing what's going on. And the other part is inflation, price stability, right? The mandate is 2%, and we're not there. In fact, we were a little bit higher on the CPI print this last time through. So Powell's like, hey, look, inflation is still sticky, right? We're still unsure on how tariffs are going to impact long-term inflation. Tariffs are inflationary, period. You can hear what you want to say politically, but there's not a person on earth that's going to sit here and tell you that tariffs aren't inflationary, right? It's going into the price of goods that are coming in the country. And unless, distributors here locally are willing to sacrifice their margins, that's going to be a pass-through cost to the consumers using those goods. So tariffs are inflationary and haven't had a major impact yet on inflation. Maybe that's the reason why inflation is sticky and not lower, because of that tariff. So the moves that the Fed has been able to make through elevated restrictive policy has brought inflation down. Maybe the last few months it's been stickier because of tariffs. We're not going to know until that story completely plays out. But these are the things that the Fed is looking at. So again, Fed rate down a quarter yesterday. Mortgage rates detached from that, but they're keying on economic data. So we got some big job numbers coming up the next couple of months. All eyes are going to be on job data, unemployment rate, and obviously inflation. So if you have questions about how that impacts you, your affordability, mortgages, refinances, cash, we're getting a lot of cash out refinance calls right now. A lot of people got that high interest rate credit card debt. They got great equity in their house. They're stumbling a little bit financially because they're not able to make good on all of their bills, and they're feeling strapped. Yes, your interest rate is probably going to go up from what you have on your mortgage, but your household rate is going to go down, and you can start saving money. Right? We can always refinance later. But anyways, I'm here to just offer this public service announcement. Federal Reserve cut rate a quarter, mortgage rates a little bit higher. They're disconnected. They don't have a direct linear outcome. We are data dependent. So as data shows it's up, good or bad, that's going to have immediate impact on the mortgage rates. The good news is we are substantially down from where we've been. Let's hope that trend line continues, because affordability is what moves the housing market. Talk to y'all soon. Thanks.